Chapter 1. What is finance? Finance is the application of economic principles to decision-making that involves the allocation of money under conditions of uncertainty. Investors allocate their funds among financial assets in order to accomplish their objectives, and businesses raise funds by issuing claims against themselves and use the proceeds raised to invest in the company to increase profits. Governments raise funds to provide services for taxpayers and to build various infrastructure projects. Finance provides the framework for making decisions as to how those funds should be obtained and then invested. It is the financial system that provides the platform by which funds are transferred from those entities that have funds to invest to those entities that need funds to invest. However, finance does much more than help us in ways beyond our financial well-being and in businesses increasing profits. For example, one prominent financial economist, Andrew Lo of MIT, has applied the principles of finance to provide guidance for how to use the field of financial engineering to find a cure for cancer, to accelerate the development of rare disease therapeutics, to raise medical research funds in the public marketing, to commercialize medical research using various fundraising techniques, and to obtain financing for vaccines for global health security. The theoretical foundations for finance primarily draw from the field of economics, and, for this reason, finance is often referred to as financial economics. The tools used in financial decision-making, however, draw from many areas outside of economics: financial statement analysis, applied mathematics, probability theory, statistical theory, management science, data science, and psychology, as we show in Figure 1.1. The field within finance that draws on the use of quantitative methods is called mathematical finance and financial engineering. This field uses advanced mathematics and is an area that has attracted mathematicians and physicists in building financial models for making optimal financial decisions and pricing very complex financial instruments. Assumptions are made about the behavior of participants in the financial markets. The attack on this field is that the models typically assume that agents act rationally. That is, it is assumed that investors are extremely smart about financial matters and make optimal decisions. This approach to financial decision-making is referred to as the rational finance. In contrast, there is a field within finance that assumes that agents do not make optimal decisions. Instead, agents have certain biases that cause them make decisions that are not optimal. This camp of finance draws on the vast literature in psychology on how individuals and groups behavior. This field is referred to as behavioral finance. The field that has recently made a profound influence in changing the financial services industry is data science. This field, which includes big data, artificial intelligence, and machine learning, is the major impetus for the development of financial technology, popularly referred to as fintech. Broadly speaking, fintech refers to the application of new technology in providing financial solutions to individuals and firms. Pure technology firms have moved into the financial services industry and begun to offer services that were once only offered by traditional financial institutions. Pure technology companies that historically have had nothing to do with finance, software development firms, hardware manufacturers, e-commerce companies, mobile technology, and data analytics platforms are seeking to take business away from banks, asset managers, insurance companies, and other household names that have provided these financial services for decades. Point 2. We provide a list of large fintech companies in Table 1.1 based on their 2020 valuation. Though these valuations change quickly, it is generally agreed that the field of finance has three specialty areas: capital markets and capital market theory, financial management, investment management. As shown in Figure 1.2, these three areas are all intertwined, based on a common set of theories and principles. Here we provide an overview of these three fields: capital markets and capital market theory. The field of capital markets and capital market theory focuses on the study of the financial system, the structure of interest rates, and the pricing of risky assets. The financial system of an economy consists of three components: financial markets, financial intermediaries, and financial regulators. For this reason, we often refer to this area as financial markets and institutions. Several important topics included in this specialty area of finance are the pricing efficiency of financial markets, the role and investment behavior of the players in financial markets, the best way to design and regulate financial markets, the measurement of risk, and the theory of asset pricing. The pricing efficiency of the financial markets is critical because it deals with whether investors can beat the market. If a market is highly price efficient, it is extremely difficult for investors to earn returns that are greater